Let's continue our discussion about CPI by thinking about inflation in general. One thing that I find that traders, it's something we all know, but we don't really think about is the fact that inflation will typically always go up. So, particularly in the US, historically, it's been going up for a long time. And the Fed, or the Federal Reserve, and specifically Ben Bernanke, is a well-known proponent of not trying to kill inflation, but of inflation targeting. Now, the problem is that if the Fed is targeting an inflation rate of around 2%, is that the same thing as CPI? No, it's not. But we can still look at CPI and kind of simplify our analysis a little bit to understand, all right, whether CPI equals the Fed's inflation target or not, we can look for these historical extremes and say, all right, when are we probably outside of the Fed's inflation target range? And therefore, what does that mean for movements in the Forex? So the chart that we're looking at right now, this is not CPI, because if we were looking at CPI, it would be a line that would start down here and it would just kind of meander to the upside. If you could buy CPI, it would be a great long trade, but because it typically just goes up. What this chart is, this is a trailing 12-month rate of change. What this means is this looks at each individual month. So, for example, here's the data point from today. So today's announcement, what is the percentage increase from the CPI index itself to the CPI index itself 12 months ago? So this shows me that in this case, CPI has increased 4.83%. We can go back in time. Let's look at one of the most recent extremes was September '05, where we had an increase from September's reading to September's reading of the previous year in September '05 as 4.53%. So the reason why I'm using this information is that it helps to show what happens when the market gets into these extremes. And it'll do one of two things, and it really depends on what's going on in the market in general. So if the U.S. economy itself is expanding or growing, such as it was back here in 2000 through the late 2001, '04 through '06, you can see we're getting into these extremes up above 3%, which is, I think we can safely say this is 3 to 4 to 5%. This is in the area of the Fed is not comfortable with this. So they're going to fight inflation. How are they going to do it? They're going to raise rates. And when they raise rates, what happens to the dollar? So let's just take a look at the chart of the euro and see, well, what does happen to the dollar during these periods. Looking at a chart of the euro US dollar, you can see these periods that we were just looking at reflected here. A little bit of an appreciation in the dollar, but certainly not the kind of trend that we're used to on the euro dollar itself here recently anyway. And that second period, as we look at it here, you can see the dollar was the trend of the dollar versus the euro is pretty stable. I mean, oscillating between 120 to 135 is not, it doesn't seem that unreasonable compared to what we've become used to in the last year and a half or so. So that's relatively straightforward, and those two periods that we looked at, the one here and the one here, on both CPI getting into these uncomfortable range or outside the target range of what the Fed is probably looking to do, and therefore turning the Fed into an inflation fighter, is relatively straightforward because it goes along with that relationship we talked about where growth leads to inflation, which leads to the Fed's efforts to try to curb and manage growth, which through higher interest rates, yields, and the value of the currency, in this case the dollar, begins to appreciate. This relationship, however, breaks down when you have a situation like we have right now, so which are most often accompanied by price shocks in the commodities market. So specifically, gold is one of those. I'm sorry, is oil, specifically oil is the big culprit with most of the price shocks that we've experienced that lead to inflation during a recessionary or a slowing economy. So a good example is we got a little spike in inflation that happened actually over several months, spiking up very near to some of these uncomfortable levels associated with bull markets here in the beginning of 2003. Now, traders subsequently start paying attention to that quite a bit here in about April of 2003, and subsequently we see the dollar weaken considerably against the euro. The problem is that we were experiencing inflation at the same time, or excessive rates of inflation. The rate of change of inflation was really going up very quickly during that period, although the U.S. economy had not yet started to grow. So we had this, and it was not coincidental, by the way, that the previous year had seen a 50% increase in the price of oil. So this is the kind of the pattern that occurs between normal periods, such as here, and abnormal periods, such as the one that occurred in 2003. Well, we can use this information to start to make some estimates about what to expect in the future. Just because the normal cycle is broken does not necessarily mean that a cycle isn't in play. So one of the things that we can expect out of a period where we're getting both very high inflation, so let's take a look at that chart. We have very high rates of change in inflation, so including a spike here. We haven't seen a spike like this in 8 years. So a spike in inflation at an all-time high compared to 8 years ago. How many of you, for example, I mean, just ask yourself, were you trading the Forex 8 years ago? I suspect that a lot of Forex traders, we have really no historical precedent, so it's very difficult to start thinking about, well, how do I manage this risk? How do I take advantage of the opportunity? One of the things that we have to run through is to say, well, if the cycle is broken, therefore, if we're getting inflation during a contractionary period or recessionary period in the U.S., that's not going to be good for the dollar. It's analogous to what was happening in 2003 when we saw the dollar really lose a lot of value versus a basket of currencies, but particularly against the euro. So let's take a look at the chart again. Now, I've zoomed in here a little bit. This is a weekly chart, so we've got a pretty good view of what's going on week by week, and I'm trying to draw a resistance line here across the top of the channel that we've been trapped within for quite some time. The market is just beginning to look like it may emerge from this channel or this bull flag here to the upside. So we can start to make some judgments about, well, it appears that inflation and the fact that the Fed's tools are being hampered, that the market is more or less taking over. It's going to devalue the dollar on its own. So this normal cycle of being able to go in and fight inflation with higher interest rates would only exacerbate the problem because it would continue to slow the economy. So to a certain extent, what I think a lot of analysts, including myself, are estimating is that the Fed is going to just try to manage the decline rather than try to fight the decline. Well, that's good, because Forex traders, what we start to look for is trades in the direction of the trend. So if we assume that the trend is going to continue to rise on the euro-US dollar, then we start to look for opportunities in that direction, so to the upside. So this is a 2-day chart that I was looking at a couple of weeks ago in another daily video, and we were looking at the potential for the market to come down, hit this upper resistance level, bounce off, and start heading up, or just a break of that upper resistance level, which has now occurred. So it's not a matter of is there going to be volatility or not going to be volatility. I think that that's one of the few things that's probably guaranteed about this market. The other one is that it appears that there is, with the rates of inflation that are at play and a recessionary environment in the U.S., therefore a Fed that has very limited ability to manage or to fight inflation is more likely to try to manage the decline. And we would assume that we're going to see a decline in the dollar versus stronger currencies. Now that may be debatable as to whether that's the euro, but we could start looking at other currencies that, although they're at fairly extreme highs, looks like we've got some more room to play. Starting to forecast some of those prices, we can use, there's a number of methods that we could look at. Here, for example, I'm just applying a Fibonacci analysis from the top of the pattern to the bottom of the pattern and projecting my price target levels up above this, which puts me at 162.30, so almost 163 or so. That's 500 pips up above where we are right now, and even very upper level resistance or target levels here at 167. Hitting these kinds of levels would not be unheard of, especially if we continue to see inflation at the kind of extremes that it's at right now. Just monitoring the trend at the same time that we're experiencing contraction in the U.S. economy. That means that there really is almost no place to go for the dollar but down, which in the case of the euro dollar means up.